2019 was a year when the economy was good, the consumer was strong, we had low interest rates. All of that was a positive for the market. But one of the things that was a little bit unusual in our view that surprised us was that we saw stocks really discounting in a good news that was further out than is typical. Apple is a great example of that because Apple stock was obviously very strong in 2019. A lot of that was euphoria and excitement about the upcoming 5G replacement cycle. Qualcomm was also a beneficiary of the same kind of 5G enthusiasm. You also saw a similar event with Nvidia. That's a stock where the stock was up quite strongly in 2019. A lot of that is really in anticipation of a gaming platform that will be released in 2020. So the discounting period was a little bit longer than is normal. And I think a lot of the excitement and good news that's going to happen in 2020 was pulled into 2019. We always use valuation sensitivity as one of the core tenets of managing the strategy. So it's not uncommon at all for us to trim from the winners and see the stocks that have underperformed during the year. Chipotle is a great example of that. It's been a terrific stock for us over the last couple of years. We still like the fundamentals, but we think a lot of that good news is really factored into the valuation, and we exited that position in 2019. On the flip side, Salesforce Com was a new position for us in 2019. That's another company with good fundamentals, but unlike most of the other technology names in the large cap space, that one actually had underperformed over the last several quarters, and we think that there's room for that one to catch up. In late 2019, we added to our position in Amazon for the first time in some time because we think that stock didn't perform as well as some of the other large cap technology names in 2019, and we think that the fundamentals there are still really good, and to some extent there's some underappreciation of the value creation there. In addition to technology, which was strong throughout the year, healthcare was a nice beneficiary in the fourth quarter. I think in large part because some of the concerns of dramatic changes in the U.S. healthcare system abated in the fourth quarter, and names like United Healthcare were beneficiaries of that. The fourth quarter of 2018 was a period of elevated volatility, and then 2019 was largely up and to the right. As we think about 2020, we have presidential elections, so we'll have a lot of commentary about what potential what our next potential president may want to do with the economy and with certain subsectors. We also have a Fed who at least appears to be less willing to act going forward, and we have slowing GDP growth. So it wouldn't surprise us if we have more volatility like we saw in the fourth quarter of 18 pop up again. How do we manage for that? I would say, we're continuing to focus on good quality companies. We've been keeping our whiteboard list well populated with names that we want to add to the portfolio if we do get that volatility, and we'll go from there.